What's up, everyone? I'm Steve, and I show you how to take the BS out of personal finance. In this video, I'm going to talk about the 3 biggest lies in personal finance. You ready? Let's go. Lie number 1, all debts are bad. That is absolutely, positively, unequivocally not true. Now, it is true that we tend to want to get rid of our debts as quickly as possible, and there certainly are bad debts like credit card debt or auto loans. Those typically aren't great debts because we're not paying that money. We didn't take out that debt in order to build wealth or to improve our lives. However, studies have consistently shown that those of us with a college degree make more money than those without. In fact, a 2009 study showed that college graduates tend to earn an average of $30,000 a year more than those who just have a high school diploma. Now, this doesn't mean that's always going to be the case. If you don't have a college degree, you can certainly make money. You can start your own business. You can do really, really well. But on average, those of us with degrees tend to make more money, and therefore, student loans is a good example of a debt that could turn out to be good because you'll earn more money, way more money in the long run than you paid in interest to get that college degree. Now, it's not always going to be quite that easy. Some of us may not end up making money. To maximize our chances of making money with a student loan, you'll need a college degree that's marketable, with good job prospects, with high-paying career options, and things like that. So it's not always going to make money. It's not just that simple. However, the numbers clearly show that college graduates make more money, and student loans, when managed properly for the right degree, can certainly be good debt. And really, any debt that goes into improving our lives can be good. Student loans is just one example, but if we take out a loan to start a business that blows up into something huge, that's another example of a potential good debt. Now, it's not to say that we should always look to borrow money when we start a business or we go back to school. Whenever possible, don't take out debt, because that makes it even easier for us to improve our lives and our money situation without that debt. But when we have to do those things, it's certainly possible to turn a debt into something good. Lie number 2, buy as much house as you can afford. I have certainly heard this before, and I'm sure you have too. The argument is we will grow into the house as our families grow and we won't have to move. So you might as well just buy as big of a house as you can afford now, and you'll be able to stay in that house longer as your needs change and family grows or whatever. But the problem with that is we're always paying for that bigger house. If we buy a bigger house than we need, our insurance rates tend to be higher. Our property taxes also tend to be higher. There's more to clean. There's more to maintain. Our utility bills are higher because we have more space to heat and cool. Now, it is true you can close off some extra rooms or close off the vents, so we're not heating and cooling those rooms quite as much, and we just pretend that those rooms don't exist. But we still paid more money to get those rooms through our mortgage, and we're paying more in insurance and taxes. It's not a good idea to buy too big of a house than we can afford. Just because your mortgage company approves you for a certain loan amount doesn't necessarily mean you can afford it. 2009, anybody? The moral of the story here is be honest with yourself about how much house you need, and if your family grows and you outgrow your current space, you can always sell your house and move into something bigger. But pay those fees, pay that money at the time that you need it rather than at the time that you don't, so you're not spending months and years paying for a house that you don't actually need. And number 3, you can't access your long-term investments before retirement without paying a penalty. For example, your 401k or your Roth IRA. Too many of us believe that those accounts are simply inaccessible without paying the 10% early withdrawal fee. That is absolutely not true. There are 2 primary ways to access that money penalty-free. One is called the Roth conversion ladder, where we convert money from our traditional 401k into a Roth IRA, and then 5 years after that conversion, we can withdraw that money tax-free. Now, you will pay taxes when you convert the money from your 401k to your Roth IRA, but you won't pay the 10% early withdrawal penalty. You just have to do it 5 years in advance. So money that you convert from your traditional 401k to your Roth IRA can be withdrawn 5 years later, tax-free, and it's just like any ordinary money that you would have in an investment account. The other way is called substantially equal periodic payments, which is a mouthful, which basically means you set up a schedule with the IRS where you can withdraw from your Roth IRA, for example, a certain amount every year for 5 years. And you will not have to pay a penalty on that money. However, it is relatively inflexible because once you have it set up, you have to withdraw the same amount for 5 years, regardless of your financial situation, without paying fees to get out of that withdrawal schedule. So once you set it up, you are committed for the next 5 years. However, both the Roth conversion ladder and the substantially equal periodic payments method allows you to get at your long-term retirement fund without paying the 10% early withdrawal penalty. I would caution against that unless you absolutely need it. However, it is untrue, categorically false to assume that you can't get to your long-term retirement accounts without a penalty. You can. And that's it. Thank you for watching. I hope you learned something. Subscribe if you're not. Like the video if you liked it. And if you think there's value to somebody else, please share this video with them. I would be very much appreciative. And we will see you next time. Peace.